Good day, traders. Stacey Burke from Stacey Burke Trading. Today talking about a new month about to begin tomorrow, June 1st. For those of us in the Southern Hemisphere, obviously a couple days for the Northern Hemisphere, but new month, new cycle, new opportunities. I consider this to be one of the best trading times to identify moves that may last, for 3 months or potentially for a couple of weeks, reversals, trend trades, maybe even just the monthly range. But today's, we talked about this briefly in the 3-day cycle video. We're going to go over and look at some of the daily charts, the monthly patterns, and how I look at tying all that together with the 3-day cycle, high of the month, low of the month, high of the week, low of the week, and then high of the day, low of the day for that 3-day cycle to potentially enter into a move that might be just for 1 week. It may be for the entire month in terms of from one whole monthly average range. So these are opportunities that I look for the best trade setup in terms of entering into a bigger move. We see this, we're going to look at some classic examples on the 1, 2, 3 on the monthly cycle and how that can be tied in with some, again, the bigger risk reward opportunities each week when we know and identify where we're at in that month using the timing of these monthly cycles. Monthly average range, whatever instrument you're trading. Obviously I've talked about focusing mainly on gold, but this applies to indexes. It applies to currencies. So whatever instrument that you're trading, this is what I do. If you find something that's of value to you, test it out. This is by no means a trade recommendation. This is the strategies that I use when I break things down from the larger time frames to identify my best trade setups. So monthly cycle, we're going to look at some examples of even when the year begins of how January, February, and March can apply the same principles that market profile talks about, the initial balance, the opening range, and in that month the same thing happens. So you will have a 3-day cycle that will set up the higher low, potentially for a reversal, for a continuation, a stop hunt, the high of the month, low of the month, when we can combine that with the high of the week, low of the week, or high of the day, low of the day, all combining for an entry opportunity. We may be targeting 20, 30, 40, maybe 50 to 1 in terms of our risk reward on some of these moves, especially if we are at the high or low of the year, which we saw on gold. We're going to look at some examples on some of the other majors. But again, go back, review the 3-day cycle video from last couple weeks. Look at that. We're going to look at some examples of that 3-day cycle, again, that played out perfectly last week, pound, euro opportunities. And again, figure out what your best trade setups are. And instead of trying to trade every move, start to understand the patterns that show up from these 3-day cycles that they use to create the highs and lows of the market when the opportunities present, what the entries look like. I keep getting questions over and over again, where do you get in? You get in at the high or the low. Engulfments, pin hammers at the timing windows. Once they've hit the stops or they've locked in a level, you're either at the high or you're at the low or you're inside. It doesn't mean you're going to be necessarily at the very extreme high or low for a trade entry, especially if they've already locked it in. You may be in a move that's jamming traders into the peak formation, stopping out anybody who's in the trade at break even or even with a small loss. So understand the logic behind what's happening with some of those moves. They're dragging traders with their indicators in the wrong direction, trapping them up high or down low, and then dropping the market 50, 100 pips away. And the average retail trader, if they have any size at all, would blow their account out with that kind of stop loss size, especially if they're over leveraged. So again, we're going to look at some of those best trade setups. The same concepts apply that I use on the 1-minute chart at the highs and the lows. We tie all this together to be at the high or at the low of the month or re-entering into a strong trend move once they've moved back into the trend to hit stops. So engulfments, pin hammers, we could have a 1, 2, 3 at the beginning of a month into an existing trend. We may have a 1, 2, 3 hitting stops at the higher low of the previous month. One of the triggers I wait for at the beginning of every month, if I'm looking for a trade opportunity, is I need the previous month's higher low to be broken. If that does not happen, I wait for the current month to put a high and low in place. Same principles apply that I use on the daily chart or the intraday charts. These combinations can offer the best risk-reward setups on an intraday trade setup. Again, I'm looking for the path of least resistance. So I understand the logic behind these moves. Trend trades are going back into the trend, hitting stops on traders that have chased the move near the end of that cycle. So they maybe they're higher level longs. The market may come back 1, 2, 3 days against the trend, maybe 4 days. The average counter trend is going to be 1 to 4 days for a strong move, and on a consolidated market, 7 to 11 days. If you're not sure about that, you can read McLaren's stuff, the study of counter trends. But 3-day setups create the trading range at the beginning of the month, the same as they do at the beginning of our week. You're either inside when the month starts, or it's already breaking out as the month starts, triggering other time frame traders into the market. If you're inside, chances are we have traders who have counter trended the market. Their stops are going to be at the extremes. Let's take a look at some charts. So we're looking at the euro, and again, the beginning of the year, the euro immediately went up, made a 2-bar reversal. 1, 2, 3 to the high, triggering breakout traders chasing the trend, or end-of-day traders, or longer time frame traders holding on or triggering breakout orders before pulling back inside. Not a complete engulfment, but the pattern is there. The next bar breaks through and reverses, hitting stops. Oops, we'll get rid of that. Hitting stops at the bottom of that range from the beginning of the month. So again, starting to recognize where clusters of volume are as we head into the ends of the month. So we have volume trapped up high. So the market breaks out, reverses, and it's a creeper down to hit the stops. So when you get volume trapped up high, and again, every move, every bull candle that closes is getting new people on board. But let's look at this. Just at the beginning of the year, we'll break this down. Again, tying this in with your Monday to Friday cycle. So the market breaks the previous month's high and immediately reverses. It's a reversal trade. Some traders may have been entering in somewhere up here at the very high based on this breakout and their 3-day cycle and their 15-minute, 5-minute, 1-minute entries. And also, the high of this bar is 49 into the 50, the mid-level round numbers, 50s and double zeros. So little things like this, we have volume trapped up high. Even a 3-day move like this, once you're in, you can be capturing profits all the way down based on whatever strategy you want. You could be removing parcels of profit out of the market, leaving a trailer in to the bottom of that cluster, whatever you like. But I'm more concerned about the opportunities as the new month begins. First month takes out and makes a new high of the year. We get a second leg down into February, triggering the higher level the longs that were up top. They hit the stops, they pull back against the trend before the month begins. The market comes down at the beginning of February without taking out the low of December, but it has taken out the low of January. We have 1 month down. Now we're into our second month down. The market reverses and engulfs. So again, if you're tying your intraday market trading in, this is the exact same strategies that I apply on the intraday basis. The first place this market's going to go is the high of the month. The same as it would as if this was the low of the week, it would come back to the high of the day. The market engulfs bear pin hammer, comes back and hits stop. So even having a one-day move for a strong directional bias that can be confirmed on our smaller time frame offers traders significant risk-reward setups. But again, we're talking about the monthly cycles and understanding that when the new month begins, there may be massive opportunities heading into the beginning of the month. Now, this is an example of a breakout pullback and then a retest of the high of the month before right at the end of the month we get a reverse pin hammer, which is a stop hunt into the shorts, the lower level shorts from the previous month. So again, understanding as the month progressed, first week, second week, third week, fourth week into the close, we had a cluster of volume trapped down low at the beginning of the month. They trigger breakout traders into the monthly end of day cycle, come back inside and hit stops at the high of the month, go back down and hit stops on traders that are long off the low, and then come back up, pinning into traders that are short before continuing the downward move. Now we're inside, but again, you'll notice 1, 2, 3 days before the market resumes its original downward drive, multiple entry opportunities, but again, the bias that can be used on the intraday basis. So the monthly cycle begins. We get a 1, 2, 3, 3-day cycle. You'll notice 1, 2, 3 at the beginning of February, and then a blow-off move and reversal. 1, 2, 3 sideways for the continuation, and again 1 month down, 2 months down. Now we have a third month down, 1, 2, 3 down. January, February, March, the market breaks new lows. So even if you're just participating in this move to the extreme again, talking about the bias, the path of least resistance, even if you're not participating in the whole move, there's an underlying directional bias for these trading days as they're headed towards the extreme. Then you'll also notice the stop hunt back up, 1, 2, 3, before the market consolidates. Very important. We get to the bottom of March, and again the 3-day cycle begins. We have our low bear candle, we have an engulfment of the bull, we have a breakout pullback, and engulfment of our lower structure. Day 1, day 2, day 3, heading into the new month, they've engulfed that whole lower structure. So understanding that regardless of wherever I would participate to get in, when I'm at the low or I'm at the high, I'm going to have a 1-bar stop, even on the daily charts. But I'm looking at the timing of the monthly cycle, whether this is because there's option expiries, because the institutions close their books, they lock in profits, they start the process again, larger time frame traders, banks, central banks, whatever that may be. I'm sure there's a plethora of reasons why. But more importantly, if I'm going to be buying at the bottom, I want to be using a 1-bar stop. If I'm going to be selling at the top, I want to be using a 1-bar stop. If I'm trading this intraday, I want to have a directional bias and an understanding of where this market may be headed. So where's the last leg down? The last leg down begins on this engulfment. We know there are stops sitting there. How does price behave when it gets to these levels? So again, an example of a 3-month cycle down, 1, 2, 3. The market reversed and trended essentially for the entire month. We get into our next month, so we have 1 month up now. We head into May, and they come back 1 sideways, 2, 3. Engulfment of the lower structure again. So these are the sort of situations we want to be looking for. I look for this all the time when I'm tying in, and even in the weeks, understanding the bias, the underlying bias that could be in place heading towards the end of a month. So the market stop hunts back into the existing trend. The first place it goes is back to the high. It stops, triggers breakout orders, take profit orders, whatever's up there, before consolidating and then doing the same thing again, coming back and stop hunting into traders that are long before consolidating, a little bullpen doji, and then bang, the trend continues. So as we head towards tomorrow being the first day of June, we have a high of the year level up at 2350. We have a market that has layered on top of these bodies from back in February, March. We'll just move this up. The market has consolidated on top of February, March's bodies. We have a pin down into the existing long trade. There may be an opportunity where we see the market retest these levels above the high of May and also the high of the year. Time will tell how price behaves will give us that opportunity, but at this current stage we have 1 month up, 2 months up. We may see a third month moving to retest that high. We could see still 1, 2, 3 up. We could see a retest inside and an engulfment for a continuation, day 1, day 2, day 3. We're going to have a day 1 of the month on a Tuesday. So Tuesday, Wednesday, Thursday, we could see a move later this week that could be a nice solid opportunity to tie in our intraday trend analysis, our intraday technical analysis in with a larger move back in the direction of where this month sets up from. Similar with the pound, we saw the pound in January. Again, coming back to the very first thing I look for is a break of a monthly high or low. As soon as a monthly high or low is triggered, I will look at a chart. The next thing we want to know is how does price behave? And this is an example of where the market triggered a high at the beginning of January on the pound, but then also stayed inside and consolidated. But we see a 1, 2, 3 before the engulfment occurs. And a market, again, this is just identifying how price behaves. So we're inside. We don't potentially necessarily have an optimal setup, but we see the market consolidating and trading sideways on top of a peak formation from December. So again, although the high was at the end of the month, the middle structure was already formed. The market broke out, triggered breakout traders, kept struggling to get up there before consolidating and layering on top at the beginning of February. So this is what I'll look for each day when I'm looking at a pair. Where is the daily chart in terms of that monthly cycle? And you can see as we head into February, we get a beautiful 4th day pin hammer that's layered on top of the middle structure of December after January's gone into consolidation. A thesis at this stage heading into February is that January potentially is the low of the year at this point. We have a peak formation low, a peak formation high, and then consolidation bullpen hammer. And this offered traders a fantastic move, directional bias for almost the entire month. But again, an example of where we see traders chasing a move towards that third and last week of the month. The market comes down back against the trend, pulls it back inside. So the same principles apply to me every single month. Am I inside or am I at or near the outside? So our high and low of the month heading into March is there. We have a 3-bar engulfment, essentially the upper 2 bars of the high of the month. This is a very bearish signal heading into March, but we're inside, so I would allow, if I'm not in an existing move, for the market to put a high and a low in place. We get a high of the month, a low of the month. We have our directional bias already in place from the sell-off off the high. The market fails to break one of the extremes before continuing its downward move in that second to third week, breaking stops and before pulling back into consolidation. So again, the same principles apply. Peak formation high, peak formation low, go into consolidation, and then identify an opportunity for a stop hunt, a trend trade, or a reversal. The market continues to stay inside of February's high-low, heading into April before, again, retesting the low of March, giving us a middle structure. And again, for traders who ask, where do you get in? I keep saying engulfments, pin hammers. If you're not sure what they are, print off your charts. These pin hammers, 2-bar reversal, pin hammer, and then the move continues back towards the high. So if I'm getting in at the bottom, again, there's the low bear structure. Our low bear, we talk about low bear, high bull. High bull's up top. low bears on the bottom. These are where the professionals are going to have positions accumulated. There's obviously orders above and below these extremes, but once they lock in a level, this is an area where if I'm positioning myself in the market, it's a 1-bar stop. So as we headed into May, again, we had a consolidated market inside of February's high-low, but we also had a somewhat of a reverse head and shoulders formation. And when we came out of that right shoulder, this was a payrolls day, it exploded back up inside of the high bull before pulling back and then continuing on the engulfment of the doji. We have not broken that high structure yet. Now this potentially is a very bullish signal in that they haven't hit the highs, but they are consolidating volume underneath of the high. This market potentially may offer an explosive opportunity for traders. Now again, this is not a trade recommendation. What matters to me is how price behaves as we head into the beginning of the month. We've broken above April's high middle structure. We've consolidated in that upper portion in the last 2 weeks of May without taking out the high. This market potentially is coiling for some explosive movement. May just be a false break reversal, but when we see this coil without taking out the high or the low, we could potentially see a big move come out of this coiled market. Now gold has again similarly given some textbook trade setups on these monthly cycles, and if we go back to the beginning of the year, we saw a 1, 2, 3 rate at the very beginning of January and a massive engulfment after the two-legged move up in December. But what's amazing about gold is it came down, and in true fashion for gold, it just continued to put in a peak formation high, peak formation low, consolidation, peak formation low, hitting stops, triggering breakout orders of January's lows before pulling back 1, 2, 3, peak formation high in February, which again is a stop hunt on these higher level shorts before engulfing, again a 2-bar engulfment at the high of the month, inside of the high of the month, continuing that move down. Again, we talked about creeping trends. Creeping trends resolve themselves in one of two ways. They will blow off in the direction of the trend or squeeze and reverse. So this is a classic example where we see 1 month, 2 month, 3 months down, creeping trend down, an engulfment off the very low structure, low of the year. The market comes up in 3 pushes before retesting that low, giving us a lower high before it reverses at the beginning of the next month in April, giving us 1, 2, 3 down, a W reversal, low of the year. The market retests the middle structure before coming back 1, 2, sideways 3 for a coiled squeeze and an explosive move back outside of the W. So at this stage we have a market that has trended now for 1 month, 2 months. Again, we talk about measured moves, high of the year up top, but we've also got stops on the breakout traders of the high bull up in this area. And at this stage, we see a strong moving market and a bullpen hammer as of Friday's close. Now, again, we could head into the beginning of the month and have a pullback retest stop hunt, but coming back to just understanding 1, 2, 3 down, January, February, March down, takes out all the lows. We have a creeping trend down, which we've talked about before. This creeping lower highs can potentially become fuel, as we witnessed on the move back up. A strong, hard moving market. Again, these are the opportunities on an intraday basis where the bias can be created Monday to Friday on our 3-day cycle for opportunities for buying low in a strongly moving up market and vice versa for a down market. So coming back to just some basic understandings as the month begins, Currently, we're inside of the high as of today. We haven't, it's Monday, but we have obviously stop losses, break-even orders, take profit orders, breakout orders, all of these things at the beginning of each monthly cycle. And we're going to see, I think, some explosive movement over the next couple of weeks. And tying this monthly cycle in with our high of the week, low of the week, our weekly highs, our weekly lows, our daily highs and lows, can give us some very significant risk-reward trading opportunities. So if we take a look at the pound last week, this was textbook again, the 3-day cycle. I talked about this. If you haven't watched that video, just scroll back a couple of videos. It's in there, the 3-day cycle. Monday, Tuesday, typically we'll identify our high and low of the week, the opening range. Now, this doesn't suggest that those two levels stay the high or the low. That creates a box of where the market now may trade into or out of that box. Now, if we get an opportunity where the market, for example, we saw this the previous week, we saw it again this week. We talked about the previous week's high and low. We opened up inside. The market gave us a high on Monday and a low on Monday. So this is the beginning of our week. That's our weekly range. The market proceeded on Tuesday to expand our range another 25 pips up, breaking the double zeros before engulfing. That established our high of the week. So then the market pulls back inside and goes into consolidation. What this is designed to do for me is to keep me out of garbage, keep me out of the inside, keep me out of chasing stuff that's moving back and forth, because I'm looking for trade opportunities that are potentially now going to move from one side to the other. Now, the other thing you may take note of is that the low of the week is just above zero. The high of the week is just above zero. On the downside, it's just above the lower double zeros, but the 100 pip double zero box is right here. Double zero, double zero. We're inside of the double zero box. So as the market trades down towards the low of the week on Wednesday, Thursday morning breaks that low and proceeds to break through the lower double zero box. Now, we talked about this last week, that this potentially may be locking in the low of the week. We see the engulfment and the bullpen hammer at the bottom. So people who have asked, what's a bullpen hammer? Well, it's a bull candle that's got a pin on it and a small body, and the engulfment essentially is that this is an example of a 3-bar engulfment. Okay? So you're going to see different subtle variations of this. This is a similar 3-bar reversal pattern in line with the existing peak formation low. So the first place at the low of the week that the market may retest is the high of the day. The market gave us a lower high before hitting stops. Hitting stops, trapping traders short again, 1, 2, inside bar 3, bullpen hammer again. So again, the stop hunt back into traders who have gone long off the peak formation low, forming our W formation at the low of the week. So again, talking about double zeros to double zeros. A W at the bottom of a double zero box on day 4, going back up, hitting stops at the high of the week. 3-day cycle, low of the week, high of the week, trade opportunity. Again, targeting asymmetrical risk reward. So for me, rather than trying to scalp 25 pips every day, which again, there are opportunities to do that, I'm looking for trades where I can lock in a low or a high potentially, and have the confidence of where I can potentially put more size onto a asymmetrical risk reward trade setup. That doesn't mean that I'm over leveraging myself on any one particular trade. What it means is, rather than taking 10 trades at 1/10 of size, I would rather take one trade at 10 times that size. So that, for me, doesn't mean that I'm going to blow my account out or risk of ruin. What it means is I'm trading less, but I'm targeting better trade setups for what I consider to be my best trade setups. And again, the timing window, you'll notice this happened right at the London Open. This W, bullpen hammer, was the last candle of the first hour prior to the London Open. London opens and boom, hits the stops, pulls back inside, hits the stops, and again, what do we see? Another bullpen hammer in line with our existing trade thesis. Okay, so these are the sort of things you will see over and over again, whether it's a downward move or an upward move. And then, of course, we head into Thursday. The market's already done its work. Friday, they pull back inside. They hit stops on the higher level longs, and again, identifying clusters of volume up high in that move. So the market takes off and shifts 50 pips. The cluster of volume is trapped in the upper 50 pip box. A 50 pip stop went down on Friday, hitting all the higher level longs before pulling back and again giving us our little W structure for a 25 to 50 pip move back up inside of Friday's range in the US session. So again, looking at the euro, and I'm just emphasizing to keep things as simple as possible. Understanding of where the better trade setups may occur, where they are locking in levels and trapping traders up high or down low. So we have our high of the week from the previous week heading into Monday. The market opens up down inside of Friday's low in consolidation, trades inside of Friday's range. Day 1, day 2 breaks the previous week's high. Sorry, we'll move that up a bit. Just double check that. Breaks the previous week's high and giving us a 3-peak formation. So again, if you're not sure, if you don't like my charts or you like TradingView better or whatever, just do it on TradingView. It's the same thing. Candles are candles. The market hits 3 pushes up on Tuesday before reversing, giving us our high of the week, initial high of the week, low of the week, initial balance. So if we come back, we'll set up Monday's low, and again we're inside of Friday's low. We know that the low of the week from the previous week is down there. We've triggered breakout traders on the break of the high of the week. But more importantly, now I'm looking for an opportunity of where the market may be giving us a trade setup up at the high of the week. We have volume trapped high. They hit that on Tuesday's U.S. session before pulling back up inside. Again, you'll notice that we're at 50, so we're between 75 and 50 as our round numbers. So just coming back to the average weekly range for the euro, just guesstimating it's in the 150 pip area. We're now looking at a level between 00 and 50. The market's only moved 75 pips. We're up high. The market hits stops up on the lower level shorts from Tuesday's close before reversing and giving us an engulfment. And again, in the timing window, this is the last hour of Asia before dropping down. So we've already triggered the weekly breakout traders. The market's come down and made a high, made a low in the Wednesday session with a sell high setup before coming down in 3 pushes into the low of that structure, trending down and dropping 50 pips in the US session. Now, if we come back and just look at the difference between this and the pound, again, not looking to trade every move in the market, looking for which pair, which instrument offers us a simple trade setup. So, yes, there was a trade here. If I was to take one over the other, to me it was no question. The pound offered a beautiful buy low setup on Thursday after triggering the weekly lows. But if I was to look at the euro and that was what I was trading, what I would recognize is that I'm in day 3. We have volume trapped up high. We're at round numbers. We've had 1 push, 2 push, 3 pushes. We've hit the previous week's high. This gives me a sell setup on an extended M formation and an engulfment. Is there a trade setup here? Absolutely. Is there a 1-bar stop? Absolutely. Now again, a 1-bar stop may be me entering in on the engulfment, even when the new hour begins, entering in, and I may place my stop somewhere in above or at that high level. It's still a tight stop. Where am I targeting? The low of the week. We might get to double zeros and it might go sideways. I might just take 50 pips. But what I want to know, though, is there price action behaving that's confirming my thesis? The market's moved up, it's trapping volume up high. It gives me a sell high setup inside of the peak formation on day 3. The first place it's going to retest is that higher low, the last low before the opening of the high of the day on Wednesday. Clears both of those out in 3 pushes, creeping trend, stop hunts back in before dropping down. So, hindsight, all that, blah, blah, blah. No, timings, numbers, high and low, 1, 2, 3, engulfments, pin hammers. It doesn't get any simpler than that. We go into consolidation on Thursday. The market eventually comes back underneath the round numbers, hits the low of the week, and what do we see? 50 pip stop hunt down. Lo and behold, engulfment, bull, pin, hammer again after the stops have been hit at the open of the U.S. session. Numbers, timings, engulfments, pin, hammers, high and low of the week, 50 pips straight back up. So these trades are everywhere, but these are opportunities when you get this combination of events and you can tie it in with your monthly cycle. The 3-day cycle is there, the high and low of the week. These are the trade setups that I look for in the timing windows after stops have been hit. Those stops can be triggering other time frame traders. It can be cleaning out profitable traders. It can be trapping traders in the wrong direction. It can be doing all kinds of things, but the reason it comes back so fast is because people are short and they're in the money here, and it's coming back to hit the stops and reverse the market, and many other reasons. We're at the end of the month. Hopefully you got value from today's video, traders. Keep it simple. High of the month, low of the month, high of the week, low of the week, Monday, Tuesday, Wednesday. Timing windows, high and low of the day, engulfments, pin hammers, round numbers. Have a great trading session. Always manage your downside. Keep it simple. Make this your best trading week ever, and may the markets go with you.
Hi traders, it's Stacey Burke from Stacey Burke Trading. If you haven't done so, please head over to my website at staceyburketrading.com. I create updates on almost a daily basis, and I would love for you to receive them. Just click on the blog. If you want to enter your name and your email address, I'll send you my free audio program, the 7-Step Daily Routine for High-Performance Traders. This is essential knowledge for all traders in all markets, and this is for helping traders to master the market with discipline, confidence, and a winning mindset. I appreciate all your feedback and comments. As always, traders, stay disciplined, and may the markets go with you.